Ladies and gentlemen, good day and welcome to the SG Mart Limited Q1FY27 earnings conference call, hosted by Antique Stock Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Pallav Agarwal from Antique Stock Broking. Thank you, and over to you, sir.
Yeah, thank you, Manav, and good evening, everyone. Warm welcome to SG Mart's first quarter FY27 earnings call. We have the senior management team represented by Mr. Amit Thakur, the Director B2B Metal Trading, Mr. Suraj Kumar, the Chief Financial Officer, Mr. Ashit Arora, the VP Service Center and Distribution Business, Namika Gulati, Senior GM Renewables Business, and Mr. Anurag Gupta, the Group Chief Strategy Officer. So now I'd like to hand over the call to Mr. Anurag Gupta for his opening remarks. Over to you, Anurag.
Thanks, Pallav, and thanks Antique Broking for hosting SG Mart for its quarter 1 FY27 earnings call. On behalf of SG Mart, I welcome all the participants on this call, and I would like to extend a warm welcome to everyone who has joined this call. It gives me a lot of pleasure to announce that Q1 FY27 is the second quarter of sustained revenue and profitability for the consecutive quarters. It proves that our business model is working well and is throwing the return and the profitability as expected. The Mart business model has evolved from trading to manufacturing, and in its new avatar, we are focusing on 5 key pillars, which are: number 1, manufacturing; number 2 is branding; number 3 is distribution; number 4 is network of service center; and number 5 is online marketplace. So under these new product categories, we have already launched 10 products, and 7 are in pipeline, which will be launched in next 2 quarters. So the new categories which have been formed are: number 1, products through service centers; number 2 is various steel profiles; number 3 is renewable structures; and number 4, various products in the accessories category. So right now, the idea in SG Mart is to create a manufacturing platform with ability to sell in own brand through network of service centers and our own distribution network. On top of that, we will have our own online sales channel to boost reach and profitability. So talking about category-wise revenue and profitability numbers. So from service center, we did volume of 160,000 tons in quarter 1. The profitability in this business is intact within range of 2,000 rupees per ton. As of now, we have 7 service centers which are fully operational, and we shall launch 5 service centers every year to take this number to 25 by 2029. The second business is steel profiles into multiple products which cater to industries like construction, infrastructure, and industries. The total volume we did here is 18,000 ton. And the capacity 18,000 ton in quarter 1, so which means for the full year the run rate is around 75,000 ton. We already have capacity of 200,000 ton for these various products which will ramp up over the next few years. The renewable structures, we did volume of around 11,000 ton. The run rate for the full year is around 50,000 ton. Here also our capacity is already around 200,000 tons. So we are having enough capacity for next 2 to 3 years to meet the demand from the solar industry. The EBITDA per ton across these steel profile business and renewable business is around 3,000 to 4,000 rupees per ton, and it shall improve as we will set up our own backward manufacturing line in next 1.5 years, which will boost our profitability to 6,000 to 7,000 rupees per ton. And the last segment is accessories, where we have already launched few products, and the revenue ramp up has already begun there. So for quarter one, FY27, if we analyze the financials, the ROC comes to around 23%, with net cash on books around 690 crore rupees. We spent 90 crore CapEx in quarter one, and for full year, we shall be spending around 400 to 500 crores. Now, given that a lot of focus is on manufacturing and setting up service centers, the total CapEx requirement in the business will be above 1,500 crores in the next 2 to 3 years. Now, 700 crores we already have on books, and next 2 3 years, we will have enough operating cash flow to meet this CapEx demand. So there is no requirement of any a new capital raising or any dilution. Everything will be funded from existing cash on the books plus internal cash flow generation. So we are overall pretty pleased with how SG Mart is shaping up, how each of the verticals is shaping up, and we are bullish on the product pipeline, which we recently launched in last few quarters, plus the new pipeline of 7 products we have already planned. Plus, there will be like new categories like contract manufacturing, etc., which we will add to the existing 4 revenue streams. All in all, we wish to have 7 to 8 revenue streams with multiple products, and which will give the scale to SG Mart in terms of manufacturing and sales through our distribution network and using our own brand, catering to multiple industries like infrastructure, construction, renewables industries, including large scale and small scale both. So by 2030, we expect SG Mart to reach a scale where it would have a unique positioning in terms of helping India and its industries in terms of manufacturing and distribution. So that's it from our side. We are happy to take questions now.
Thank you so much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have our first question from the line of Rehan Syed from Trinesta Asset Managers. Please go ahead.
Yeah. Hello, good evening. Am I audible?
Yes, sir. We can hear you.
Yeah. Yeah. So my first question is around your customer side. So your SG Mart has built relationship with more than 2,500 customers across EPC, industrial and infrastructure segments. So how concentrated is the revenue today, and do you see customer concentration reducing further as newer product categories mature? And just continuing with this part, could you please help me understand the landscape in the organized infrastructure material distribution business? Like what structural advantages allow SG Mart to defend markets against regional distributors and other regional players? This is my first question.
Thanks. So coming to the first part of it, the customer concentration is very, very wide in SG Mart's case. You got to understand the customer base as per the product category. So, for example, number one product category is service centers. Now, service centers, our customer base is widely spread out because we have customers in terms of small fabricators to large fabricators, capital goods companies with small to large scale, then EPC contractors, pre-engineering building companies, white goods companies, automobile sector, agricultural equipment companies, right? So it has a very wide range of customer base where the concentration is very, very wide. Okay. Then second is steel profiles. Now, if you look at the applications for steel profiles, which is again into renewables and infrastructure in industries, housing construction, commercial construction, so all type of segments, infrastructure or real estate, it caters to. Again, the customer base is very, very wide, and there is hardly any concentration. Then, solar structures, yes, this business has a limited number of EPC companies and independent power producers who are present into renewable solar structure, solar business. So here, it'll be like top 20, 30 EPC slash IPPs, which we would be catering to. But then again, right now, the solar structure business is contributing very little to the overall revenue of SG Mart. So again, customer base is very wide. And lastly, accessories, again, it is sold to number of large customers, number of small customers, sorry. So here also the risk of concentration is not there.
Okay, fair enough. And like you have mentioned about the steel profiles. So, sir, what revenue and profitability contribution do you expect from steel profiles and solar structures over the next 2-3 years? Any number in your mind?
Now, of course, right. So put together, if you see 18,000 ton we did in steel profiles and 11,000 ton volume we did in solar structures. So put together, it is 30,000 ton in quarter one. If you analyze, it is around 120,000 tons. Put together, we already have capacity, installed capacity, of around 400,000 tons. So we can grow this business by 3.5 to 4 times in next 2 to 3 years, meeting the industry demand.
Oh, okay. Got it. Got it. And the last one question from my side, then I join in the queue. So, sir, what are the biggest execution risks to achieving the target that you have given 50% gain over the next 3 years that we have to keep in our mind while analyzing the company?
So see, again, we need to break up execution risk into 4 separate business verticals. Service centers, we wish to have 25 number in next 3 years, right? So we already have 7. We have already started working on 7 new centers. So 12 centers will be up and ready, say, in next 6 months to 1 year. So once we achieve 12 operational service centers, then doubling that number in 2 to 3 years' time, it should not be much of a problem. When we have already identified cities and land parcels, we know the business model, how to run that service center, what kind of market and demand, etc. Everything is mapped, right? So execution risk gets very, very low. Now then the second is solar structures and steel profiles, the other 2 product categories. Here also we have already installed profiling capacity of 400,000 ton versus 120,000 ton run rate what we are at today. Now here the bigger part is to set up the backward integrated line. Okay, because both these product categories, they use special coated steel. Okay, so right now we are purchasing that special coated steel from third parties, but SG Mart wishes to have its own fully integrated line. So that process we have already started by acquiring land in Raipur, and in next 18 months the backward integrated line will be fully operational. Here also the group has lengthy experience in putting up such lines. So given the project has already kick-started, execution risk doesn't play much of a role here. And third, adding new products in the accessories. We have a lot of service centers with idle space. So infrastructure is already there. We need to put up we need to put up machinery to start manufacturing such products. So given all the cash lying in the books plus solid operating cash flow generation in the next 2 to 3 years, we don't see much of a risk to put up these lines.
Okay, sir, got it. And thank you for the detailed clarification. And good luck for your coming quarter, and I'll just connect you.
Thanks so much.
Thank you. We have our next question from the line of Vishal Mehta from Oaklane Capital. Please go ahead. The next question is from the line of Vishal Mehta from Oakline Capital.
Hi, am I audible?
Yes, sir. Please go ahead now.
Hi, Anubhav sir. Just a couple of questions. First is that this quarter we've seen a healthy jump in the realizations because of the pricing increase. Could you just break that down? So we've seen also a margin improvement which has been strong. So could you highlight if there was any inventory gain or this is a structural shift in terms of how we should look at margins going forward as well?
Vishal, see, if you look at the NSR, that is net selling realization, yes, it has gone up. So one is, yes, steel prices went up, right, by around 2,500 to 3,000 rupees per ton from 1st April to 30th June period, okay? But also NSR is up because of increased sale of steel profiles and renewable structures. Okay. So like I said, this is a special coated steel where the realizations are almost 10,000-15,000 rupees per ton higher than the average HR coil based product what we sell. Okay. And the revenue mix, as you can see in the table, the contribution is increasing quarter on quarter. Plus the margins also in these products are superior, which led to EBITDA margin of more than 4%. Now, just to add to it, inventory gain is very, very minuscule because if you look at the inventory, absolute inventory, like in FY26, March 31st March 2026, the inventory lying in the books was 283 crore rupees, and in quarter one by 30th June it fell to 209 crore rupees. So despite high steel prices, our absolute inventory has reduced significantly. Okay, so we are improving our inventory churn. So since the inventory reduced, so there was not much scope of booking any inventory gains. And that's what we're going to continue with the better inventory churns. The risk of inventory losses or gains in P&L, we want to minimize, like how we did in APL Apollo Steel Tubes. Similarly, we want to achieve that in SG Mart as well.
Got it. So just to sum this up, you're saying that this 4.5% EBITDA margin that we've done this quarter seems more structural than a one-off because of better pricing.
Right. So I will not guide EBITDA percentage right now, Vishal, because like quarter on quarter, because in next quarter, say in quarter two, if the service center business picks up, which was pretty slow in quarter one, and here the margins are like 1,800 to 2,000 rupees per ton. So if revenue mix from service center business increases, then my blended EBITDA per ton may come down. Okay, but absolute EBITDA will definitely grow because the steel profile business and renewable business will do more volume than it did in Q1, because every quarter you will see the ramp up. Okay, but at the same time, my revenue from service centers may increase, right? So tough to give guidance for EBITDA percentage or EBITDA per ton quarter on quarter, but absolute EBITDA will definitely be superior than previous quarters.
Got it. Sir, just a compliment that the incremental information in the presentation has been very helpful. Just a suggestion, if on the slide 19, where we've mentioned 16th slide number, where we've mentioned the segmental split, if you could also add the EBITDA for each segment, it will be really helpful for us to track the performance more granularly. So that's just a suggestion, because we do that in APL Apollo as it is. So we're just extending it to SG Mart as well. So thanks again.
That's well taken, Vishal. We'll work on it. Thank you so much.
Thank you. Good luck.
Thank you. We have our next question from the line of Sneha from Nuvama Wealth. Please go ahead.
Hi team, congratulations on good set of numbers. Just a couple of questions from my end. Could you actually help us with the service center economics? How much time does it take to form one service center? How many kilometer radius could actually one service center cover? And its economics, like how much are you putting in? And some division between land and probably machine, and then, what could be the throughput that we can attain from each service center? Broadly, this is the first one, yeah.
So Sneha, when we say that we wish to have 25 service centers by 2029, 2030, so idea is to cover pan-India, right, with each service center being present and operational in every industrial cluster of India. Okay, so what homework we have done is that every 400 to 600 kilometers, so on an average of 500 kilometers, you will find like one large industrial cluster coming up. Okay, so you'll find our service centers which are widely spread across and each being at a distance of 400 to 500 kilometers from each other. Right, so that's the basic fundamental that we want to cover whole India. We want to cover each and every industrial cluster of the country. Now the maths how it works is that typically you want to have like 5 acre to 10 acres, okay, depending on the size of the service center. But typically it's 5 to 6 acres service center you want to have, and it will have a covered area of minimum 100,000 square foot. So and it will have like typical machinery of slitting and cut to length and embossing, etc. Okay, so normally it takes around 50 crore rupees to 40 crore to 50 crore rupees to put up a service center of this size, which I mentioned. And right from the land acquisition to install machineries, having built up area, everything, it takes like 9 months to 15 months. Again, depending on how quickly we are able to get land cleared, etc. Okay, so 9 months to 15 months is the time period where we are able to set up these service centers. So like I said, 50 crore is the gross block investment which we put up initially. Now service center does business of around 8,000 tons per month, which means around 40 crore of revenue per month and 500 crore per annum. Having working capital requirement of 20 days, so which means that we need to have 25 to 30 crores of working capital investment in the service center. So 50 plus 25 is 75 crore to 75 crore to 80 crore of total capital employment. And if we do 8,000 tons per month, that means 100,000 tons per annum with 2,000 rupees per ton EBITDA. So we will get EBITDA of 20 crore rupees on a capital employment of around 75 to 80 crores. So this is the economics which we work on. Now there are two levers to boost ROC further from these levels. Number one is the B2B metal trading, okay, which right now is not much of focus area. But as our reach is expanding, right, so we will get demand for bulk sales also, right? So as we are able to aggregate demand for B2B metal trading, as more service centers open up, we can always do trading, right? And there is no investment required for B2B metal trading. So it will boost my ROC, right, without investing any dollar. Second, we will start sell. So right now the products what we sell in service center are number one metal sheets, HR coil sheets, okay, embossed sheets and slitted coils, etc. Now we want to add coated steel also here, okay, for which the backward integration plant is being put up in Raipur. So once that product line starts, it will improve my same store sales growth. And since it's a specialized coated sheets, the margin also will be like 5,000 rupees per ton versus 2,000 rupees per ton what we make on hot roll HR based material. So I mean service centers can also give us 35% kind of ROC once both these products start adding to the revenue.
I got that. My second question was, I think in your opening remarks, you said you are also working towards some sort of a contract manufacturing, which may come up. Would you want to, expand that? What are you thinking about? Which areas, what contract manufacturing?
Yes, Neha. So maybe next quarter we will have some accurate answer to that, right? We are exploring various industries where there is a gap in giving manufacturing ecosystem to the companies who are selling under their brands, right? It could be in multiple categories. Obviously, we'll start with one, make it successful, and then we go to the second category. So maybe in second quarter call, we will be able to give you exact what we have done.
Understood. Last two questions. One is on the customer diversification. I think you mentioned it very well that your customers are completely diversified. Could you explain how is the order book with these customers? How many days of order book do you entail? What sort of need to orders do you receive? And, what's the turnaround period? How much inventory do you have to, maintain?
So Sneha, except solar structures, most of the business is off-the-shelf product. Okay. And we get regular orders from the customers. So normally the turnaround time would be like 24 hours to 48 hours. Only in solar structure business, which is like slightly project specific, the order book stands for like 2 to 3 months. Else, everything is like off-the-shelf segment.
Understood. Thanks a lot, team. All the best. I'll get back in the queue for further questions.
Thank you. We have our next question from the line of Rahul Kumar from Vaikarya Fund. Please go ahead.
Yeah, hi. Just one question, I think, going back to the profitability part. Can you just help us understand the EBITDA per ton for the various segments for this quarter? And what would be the sustainable figures going forward for these segments?
Sure. So coming to the first sort of category, which is service centers, here we make anywhere between 1,800 to 2,000 rupees per ton. Okay. Then second, steel profiles, we make around 3,000 to 4,000 rupees per ton, which is based on the purchased coated steel from outside. Similarly, in renewable structures, solar structures, we make around 3,000 rupees to 3,500 rupees per ton. Again, it is based on the purchased material from outside. Now, in both these segments, once our backward integration starts, say in 1.5 years, the margins will increase beyond 5,000 rupees per ton. And lastly, on accessories, again, these are like specialized accessories where the margins could be like in double digit, depending on like multiple products. So that's what it is.
Okay. For this particular quarter, are there any one-offs? Because this number...
No, there is no one-off. It's all regular business profitability.
Okay. Understood. Second question which I had was on the working capital. I think there is a slight increase in the total working capital because of the trade payables which has gone down. So is this more of a...
That is one. So again, our current assets have gone up. If you look at our balance sheet, what we have given, the other current assets have increased to like 211 crores from 188 crore rupees. So this is again the advances what we pay to the steel mill. Now, in last 4-5 months, because of all the geopolitical turbulence what we have seen, we always want to have a credible source of steel. So for that we always have some advances lying with the steel mills. Okay. As our scale improves, this will definitely come down. So it will improve my working capital days. And also, like, these are the new business verticals what have been created. So initially, it will have some extra inventory. And like you saw that we have already brought inventory from 283 crores to 209 crore rupees, despite increase in the steel prices. So absolute reduction in inventory in tonnage is much more sharper than what you see these numbers in value. So this will continue, and with better payment terms, credit terms with our steel suppliers, you will see inventory being further, the working capital being rationalized from current levels.
Okay. Okay. Actually referring to the trade payables part, which has actually declined, from
Your trade
500.
payables are also the money which you have to pay to your suppliers, right? Which is mainly steel mills. So here also, we have made payments, right, to ensure that there is regular supply of steel. It's just that the scenario in the geopolitical scenario is turbulent. It's always better to play safe. Now that all our processing units, our sales channel, everything is being established, so we don't want any disruption in the steel supplies.
Okay. Okay. And in terms of capacity, what you mentioned for the profiles and the renewables. So the launch product which you have shown in the presentation, so the capacity is versus these products?
Yeah, that's right. So number one, product number one, if you go to slide number 7, okay, so number one product is strut, which is part of steel profile. Then VC purlin, number 3 product, that's part of steel profile, racking profiles, cable trays. Okay, so these are part of the steel profiles, and solar module mounting structure is part of solar structure. So for product 1, 2, 3, 4, and 6. Plus there are 2, 3 more products which we will launch. The capacity is already there, which we will launch in quarter 2, quarter 3. So put together, we have installed capacity of 400,000 ton, and in quarter 1 we did 30,000 ton for both the segments in total.
Okay. Okay. So in that context, you had mentioned in the opening remarks that you'll spend some 1,500 crores on the CapEx. So which particular segments will be these,
Okay. So number one is service centers. So right, we have 7 in operation, right? We need to open 15 more, 15 to 18 more. Each service center requires 50 crore of investment.
Right.
Right. So this is one number. Okay, say 18 into 50, which is like 800, 900 crores, which will be put up to acquire land and build sheds and install machineries. So total gross block formation. And then some CapEx for the backward integration line of coated steel.
Okay. And then backward integration will be a centralized facility, right? Not
That is right. In Raipur, yes.
Okay. Okay. And have we incurred the CapEx for that, or is it still ongoing?
So land has been acquired and the construction has begun.
Okay.
And some machinery has also been ordered.
Okay. Okay. That's it. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to only 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Garvit Goyal from Serene Alpha. Please go ahead.
Hello, I'm audible?
Yes, sir.
Hello. Yes. Hi, good evening. Sir, my question is on service center. Like you mentioned, in this quarter, there are some issues, and hence the business was slow, which will ramp up in Q2. And looking at the target number, earlier we were targeting around 30 service centers by 2030. Now we are speaking about 25. So I just wanted to understand, are there any challenges that we are facing right now in the terms of adding up the new service centers as well as ramping up the existing ones?
So, see, if you look at the quarterly volume, Q1 FY27, the volume was 160,000 tons, right, from service centers. Now, QOQ, there is a dip, right, which because of seasonality, but in Q1 FY26, the volume was 120,000 tons. So we have increased from 121,000 ton to 160,000 ton on YOY basis. So there is no slowdown. When I said that volumes were soft, that was because on QOQ basis, right, and that was due to seasonality. Now Q2, the volume shall pick up, right, QOQ, and that's what I meant. So we are looking at YOY growth here because all these products have seasonality, right? Not to be compared on QOQ basis in terms of volume. What was the second question?
In terms of our long-term target of establishing.
Yeah, that's right. Yeah. So see, again, this number is 30, 25. It doesn't matter. What matters is that are we covering pan-India? Are we covering each and every industrial cluster in Indian state? So yes, we are doing that. Okay. Are we able to achieve 800,000 ton monthly volume from 25 service centers? Answer is yes. So it is not about number of service centers. It is about the coverage, and plus it is about the revenue, the volume what we can generate from each service center.
Got it. And secondly, for this year, like you mentioned, in the upcoming quarters, in absolute terms, maybe relative terms, it can vary, but in absolute terms, we will be seeing improvement in EBITDA on quarter basis. So what kind of EBITDA target do we have for this particular year, financial year by 27?
So see, I mean, we had mentioned like in quarter four call, okay, we had mentioned around 300 crores for FY27 in terms of absolute EBITDA. I think, I mean, given the momentum what we have got in quarter one, and assuming there is no such drastic deterioration in macro environment because of ongoing geopolitical tension, we should be able to do that, unless, like the only caveat is some disruption at macro level.
Understood. And are you seeing any kind of disruption right now, means that can be a challenge to our...
Sorry to interrupt, sir. May I please request you to rejoin the queue as there are several participants waiting for
So
their turn.
just to close this loop. So see, disruption, yes, I mean, till 10 days ago, we were of the view that now war is getting over between Iran and US. Okay, now the the oil prices have again started to shoot up. It will again have a rub-off impact on the commodities, including steel. So if there is too much of volatility, it will impact sales for sure. Okay, and lot of industries, lot of customer industries will suffer, right? So it's been only 10 days since the war has restarted. I think we'll take another 2-3 weeks before it starts hurting businesses. I mean, in March, everyone suffered because of shortage of fuel, gas, petrol, diesel, right? So if that situation comes again, then the whole country business environment will suffer. Nothing specific to us, nothing specific to our business, but in general, if things become worse, it will impact.
Got it, sir. Thank you very much, sir, and all the best for the future. Thank you.
Thank you. We have our next question from the line of Jatin Damania from Swan Investments. Please go ahead.
Good evening, and thank you for the opportunity. First of all, congrats on a good set of numbers. Anupam, just want to understand, in your opening remarks and couple of times you alluded to a backward integration initiatives that the company has been taking. So can you throw more light, what sorts of backward integration are we looking at? Is it a galvanized or is it a CRM? And what sort of incremental EBITDA per ton one can expect on a steel profiles and renewables due to that?
So definitely we get HR coil from the steel mills. It needs to be cold rolled, then it needs to be coated, whether it's zinc or zinc plus aluminum or zinc plus aluminum plus magnesium, right? Because these are the three segments where which we are catering to right now. Okay, so this is so it is cold roll plus metal coating. Okay, this is what we're talking about. And margins, through backward integration can be improved by 3 to 4,000 rupees per ton.
3 to 4,000. And with the installation of, what is the capacity, and once the CRM comes into operation, what sorts of improvement in the working capital cycle one can see?
So, right now we are buying this raw material from outside, right? So definitely we need to stock more. Once it is everything is backward in-house, so raw material requirement will definitely go down, in terms of storage, right? That's why we are confident that the current working capital days of 27, we are going to come down for sure. We will settle between 20 to 25 days in next 2 years.
Sure. That's all from my side. Thank you, Anupam, and all the best.
Thank you.
Thank you. We have our next question from the line of Vikas Mistry from Moonshot Ventures. Please go ahead.
Sure. Thanks for the opportunity. And go ahead. In opening remarks, you alluded about CRAMS, contract manufacturing. Won't it be slightly ROC dilutive? Are we aware of the fact that if we got into high capital intensive manufacturing business, then it will be slightly on lower side of ROC?
No, Vikas. So see, as a group, as a company, we always aspire to do anything above 25% return profile. Okay, same applies to SG Mart. Now, and like I said, there will be like multiple revenue verticals. So one vertical could be like 30, 40, 50%. One vertical could be like 20, 25%. But what I can tell you is that any vertical, we will not dilute ROC below 20%, ROC below 20%, no matter what. So please be rest assured, we will not do anything which will dilute company's ROC.
Oh, great. So good to hear about that. So in one of our very long-term vision, we have alluded that we will have 10 million tons of steel going through our platform. But out of that, 33% is like trading. But as of now, we see that the trading will not be the significant portion. It may come as a maybe margin increasing level for my service center business. But on long term, how do we think about the bifurcation mix, which will not be on trading side? So how we are trying to plan for that?
Sure. So from service centers, we wish to achieve around 10,000 tons per month from each service center. Okay, so if I have 25 service centers and 10,000 tons per month, so for the full year, we're gonna do 3 million tons from this. Okay, from service center business. Then 500,000 tons we're gonna do from solar structures and 500,000 tons from the steel profiles. So this put together 4 million tons, and then there would be accessories, etc. Right. So I think put together we should be anywhere between like 4 to 4.5 million tons. And B2B metal trading, it can be anyone's guess. Okay, if there is an opportunity to become a reseller in steel, we have already tried that in the past, and we will not shy away from doing that again. So that could be anyone's guess. But focus is to do this 4 to 4.5 million ton of value-added products, okay, which will give better EBITDA spread and better ROC.
Okay. So you still bank on trading as a part? But,
no, we are not. No, we are not. Okay. I'm saying 3 million ton from service centers. Okay. And 1 million ton from solar structures and steel profiles. So 4 million ton has 0 ton of trading, right? It's pure manufacturing or having a network of service centers processing. Okay. B2B metal trading can be anyone's guess. We don't know, right? If you look at our quarter 4, quarter four volume, my B2B metal trading was only 17,000 ton in one quarter. So that means on an average, on a full year basis, it is 60,000 ton, not even 100,000 ton, right? So giving any number to this is useless today. But what I'm saying is we are ready. If there is an opportunity, we are ready. If there is not, then my SG Mart's vision is not dependent on this volume.
So good to hear about that. So congratulations to the team on at least on backward integration side. We wish to continue to backward integrate and continue to have high value margin products. Thanks. That's all from our side.
Thank you.
Thank you. We have our next question from the line of Olen Suba from Cycus Investment. Please go ahead.
Hello. Hi. Am I audible?
Yes,
Hello.
sir. Can you please be a little louder?
Yeah. So can you hear me now?
Yes. Please go ahead with the questions.
Yeah. So my question is on the customer side. So SG Mart's original business model, if I'm correct, was built around serving the fragmented MSMEs, aggregating supplies from large steel manufacturers. Now that we have transitioned towards higher margin service centers and value-added products. So I just want to know, are MSMEs still the primary target base here, or has the focus shifted toward larger, industrial customers or OEMs?
That focus remains because that MSME and SMEs, they are buying our product from service center. Okay, service center, we are not selling our products to Maruti or Honda or Hyundai or Samsung or LG. Okay, our main customers are SME and MSMEs. Okay, whether small industries or small traders.
Yeah. And my second question is is the growth in value-added segment being driven by, increasing wallet share from existing B2B trading customers, or is it primarily, coming from acquiring entirely new customer base?
It's acquiring entirely new customer base.
Okay. Got it. Thank you for my side, and congratulations on the, great set of numbers. Yeah.
Thanks.
Okay.
Thank you. We have our next question from the line of Pawan Kumar from Shade Capital. Please go ahead.
Thank you for the opportunity. I'm audible?
Yes, sir.
Can you hear me?
Yes, sir. Please go ahead with the question.
Yeah, my question is, can you tell me some color on what sort of competition intensity in our kind of business? Who are the players, or what sort of target addressable market we have? Some color on that.
So again, here we need to go business by business. Now, in service centers, we are the only company which is setting up service centers at national level. So there are like small service centers like mom and pop stores everywhere. But as a formalized, as an organized, as a pan-India national player, we are the only ones in the country who is putting up such kind of business model. Now, in solar structures, again, there are multiple profilers, okay, who buy material from steel mills and then profile it and sell to solar sector. Now, here our USP is having the profile centers at multiple locations, plus having our own backward integration in terms of steel, right? So that puts us apart from any existing player in solar structures. Now, same theory goes with the steel profile business. Here also there are multiple small profilers who buy steel from steel mills, and then they profile the steel and sell it in the end market. Now, here my strength is that, or I would say my USP is that I am having profile machines pan India at my service center. Plus, we're gonna do backward integration for coated steel. So again, it puts me ahead of any of my competitors. And fourth business, which is accessories, here also it will be like multi-product at single location. So no one is working on this model. So all in all, what we believe SG Mart is like China in making. Okay, like how manufacturing gets scaled up or has scaled up in China. Same, we want to replicate that in SG Mart, right? Which will keep us ahead of small competitors by far much.
And do you foresee any big player coming into the same arena as you are in, or is it?
See, I mean, we are working on so many revenue verticals, right? And it will be beyond the steel. Okay, it will be beyond the construction industry, it will be beyond industrial application, it will be beyond the renewable space, right? So multi-product, industries, multi-application, multi-channel, service centers, distribution network, online sales channel. Okay. So it will be very tough for any big entrant, right, to focus on so many categories and try to become SG Mart.
Okay. So in this background, would you like to grow faster than what you're really guiding us? Because you are the, I think.
See, I mean, what we can talk about so what we can talk about is the building blocks, right? We'll keep on discussing about those building blocks, what we are doing. We'll keep on putting that into presentation. That's why we put the products, what we have launched, what we're going to launch. Okay, now result, definitely. I mean, we have done a lot of homework in terms of mapping customer base, in terms of mapping new products. So we are confident that all this will be successful and it will show numbers maybe more than what we have been guiding for. But at the same time, there are a lot of moving variables which are beyond our control, like geopolitical situation and macro environment. I mean, if things remain on expected lines, yes, we may perform better. Otherwise, we request you to stick to the guidance what we are giving. But there is lot of buffer.
Sorry to interrupt you, sir. We request you to rejoin the queue as there are several participants waiting for their turn.
Thank you for the answers.
Thank you. We have our next question from the line of Akash Srivastav, an individual investor. Please go ahead.
Hello. Thank you for the opportunity. Congratulations for the good set of numbers. I have seen your vision 2030. Just want to know that if we are able to achieve this from 5 industries to 20 industries and different means 20 plus service centers. So what will be our top line or tonnage and EBITDA for 2030 if ever we have calculated about this, and whether we will be able to increase our OPM in the meantime of.
This is the business model what we have built. Okay, we believe that with more than 4 million ton in steel volume, the revenue could be like 25 to 35,000 crore rupees by 2030, and with minimum 1,000 crore EBITDA.
Okay, and whether means EBITDA margin of something 3 to 4%.
That's right.
Okay. And just want to know one thing for the FY27. We have been guided for 50% CAGR for next 3 years, and for 300 to 250 crore of EBITDA for FY27, and 250 crore something PAT for FY27. So if war does not hurt us more, so whether we will be able to achieve this target or not.
Yeah. So see, I mean, if I do 50% CAGR on FY26 EBITDA, which was 140 crore rupees, I reached at 700 crore in FY20 and in FY30. I reached 700 crores in FY30, wherein I'm guiding you for 1,000 crore.
Yeah.
Okay, so
Actually, I'm asking for FY27. Actually, you have been guiding
FY27 also, yes, we will be able to achieve this guidance easily.
means 300 crore or 300 to 150 crore EBITDA and 225 to
No,
150 crore.
50% CAGR, 50% CAGR is 50% CAGR, 50% growth on 140 crore is 210. So I'm saying that we should be 300 here and there, minimum.
300 means 210 EBITDA or 300 EBITDA?
300, I'm saying.
300 means in terms of PAT, I think we should cross 200 crore easily for FY27.
PAT you can calculate depreciation and other income and tax rate.
Okay. One last question from my side. You have been guiding for online marketplace. I just want to know that whether this is like IndiaMart or which is a buyer and seller platform, or it will be something different.
No, it will be for the products, what SG Mart will be manufacturing and trading.
So
First phase is to develop that channel.
Okay. So who will be able to buy this means from dealer or something? Whom you are targeting?
Maybe same customers who are buying from me offline, and plus new customers will get added with the better reach.
Means it will be one of a kind of a platform in India. Is there any type of platform available right now?
No.
Okay. Thank you very much.
Thank you. Ladies and gentlemen, that would be the last question of the day, and I now hand the conference over to Mr. Anubhav Gupta from SG Mart. Over to you, sir.
Thanks, everyone, for joining this call, and thanks again to Antique for hosting SG Mart for its Q1 FY27 earnings call. It's been a good quarter. I would say, in fact, last two quarters have been fairly good, where we have been able to demonstrate our ability to evolve SG Mart's business model from a trading platform to a manufacturing platform now. We are excited about next 2 to 3 quarters product launch pipeline, where we can add or we would add much more products and add more categories beyond 4 which I mentioned about, and definitely you'll hear about contract manufacturing, which some of the participants wish to know about. So every quarter on every earnings call, I would be talking about new products, what we would have launched in the quarter, and new product pipeline. So stay tuned for all the excitement, for all the new products, all the business categories, which we will keep on adding and adding to our launch pipeline. Thanks, everyone. Have a good evening.
Thank you, sir. On behalf of Antique Stock Broking Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.